Good afternoon and welcome to BizTech's ASEAN Midday Market Watch. Our guest today is Gabriel Yak, Executive Chairman of GCP Global. Gabriel, great to have you on the show again.
Thanks, Brian.
Now, Gabriel, let's take a look at how markets in the region are performing. We'll start close to home. We'll start with Bursa Malaysia, which is at 1,597.04. It's down marginally, 0.04%. SGX is at 3,155.05. It's up 0.42%. Across the region, it's a sea of green. We've got the Nikkei up 1.55% at 29,174.24. Shanghai Composite is at 3,409.77. It's up 1.37%. Hang Seng is at 28,218.31. It's up 1.14%. ASX 200 is at 6,822.6. It's up 0.5%. And rounding off, we have the Kospi, which is at 3,033.23. It's up 0.83%. Now, Gabriel, what's the reason and what's driving markets to the sea of green across the region?
Well, I think essentially, Brian, the focus has been the case since late February about the movement on the US Treasury Bill. So since the program last week, you noticed that the sell-off actually climaxed in the short term at 1.72%. That was last Thursday as we spoke. And henceforth this week, they have actually slid down. And yesterday, the 10-year Treasury Bill is at 1.61%. So it's actually back to the previous beginning of the week kind of rate. So I think that actually allows the market to refocus back on fundamentals. And what are the fundamentals? The fundamentals are essentially the results season, which is actually very much in vogue currently.
Mm-hmm. And now I want to zoom into China, because we've just had, just late yesterday, the first quarter survey by China's Beige Book, and found that borrowings by state-owned enterprises dropped to the lowest level in the study's 10-year history. So is China again in deleveraging mode?
I think China essentially has done one of the most deleveraging job across the world in a much better way. So take, for example, compared to the US debt upon GDP has actually gone up to 7 trillion. So essentially, that's 3 times growth in the course of the last 12 months because of the pandemic and because of the stimulus packages. Most of the EU countries are actually following suit. But if you look at China, it's different. The fiscal measures and stimulus measures amounted to about 1.6% of the total GDP of about 11-12 trillion. And you notice that essentially, instead of actually increasing the debt, you notice that both fiscal measures as well as better monetary policies have facilitated how China was able to accommodate their businesses in terms of the COVID-19. And now that they were the first to recover, we notice that the government right now is actually, and has rightfully pointed out and managed to bring down the SOE debt. So we notice that in fact, many of the SOE debts are being rearranged for longer term maturity. And guess what? They're actually being done at a lower rate of interest, which would be beneficial in the next 10 to 20 years.
And so, leading on to that as well, China and Hong Kong stocks have been trading lower and underperforming their global peers over the last 2 weeks. Can you just give us some insights into why that has been happening?
Well, it's just been a slew of bad news since the market hit its peak in the middle of February. You actually have, for example, last night, the holding company discount. This has actually been put into place in the US, meaning that if you're actually listed in the US, the likes of, say, Baidu, Alibaba, Bilibili, you would basically be subject to the books being actually audited by US appointed auditors. And you also need to name the people who are actually part of the military, supposedly, So it's essentially a bit hard to navigate, but the markets are basically taking this way. That is, if there are uncertainty, sell first, ask the questions later. And that's why it's actually been causing one bad news after another. Now, before that, of course, that is actually the week before we had our interview. You notice it was actually Chinese clampdown. Xi Jinping has actually mentioned that essentially many of the tech giants, the monopolistic practices have been examined in further detail, while no or not much of a heavy penalty is being actually penned out to the likes of, say, JD.com, Alibaba, other than what actually that is mandated under the SAMR ruling. You notice that it adds a heightened amount of uncertainty to the market and tech stocks. And that's basically why the market, and particularly so for China tech, has been dribbling downwards.
Now, in terms of uncertainty, there's also opportunities for the brave. Where do you see opportunities to buy or accumulate, not only in China, but regionally?
Well, not only in China, but in the US for tech. When I actually look at tech, I find this is the best opportune time because to be accumulating, because my experiences way back in 2018 when Tencent and the likes of the other gaming companies like NetEase were being hit by the imposition by the authorities in terms of investigation into online gaming, its effects on minors, and the restrictions on gaming. It took like 4.5 months, for the stocks, that's basically Tencent and NetEase, to find a bottom. And essentially, from the bottom, if you had bought, you notice that you would have more than quadrupled your money between the period of between December 2018 right up to February of this particular year. Despite this current sell-off, they are up like 300 to 400% for the likes of NetEase and Tencent. I see this kind of scenario probably being played out, with respect to the anti-monopolistic clampdown on the big tech companies like Meituan, Pinduoduo currently.
Now, Gabriel, final question. I want you to give some insights into the retail investment climate in Southeast Asia, particularly in the likes of Singapore, because retail investors came up in force back into the market last year. Is that still happening this year in 2021?
I think it's a continuation of the momentum built up from last year. So, for example, when I look into the two online platform-based brokers that established in Singapore, using Singapore as a beachhead and headquarters, the likes of Futu, which actually launched its Mumu program, as well as Tiger, which actually launched its Tiger program in Singapore, it's quite evident that the retail momentum is continuing from here. But it's interesting in the sense that the bulk of the trades that are done on both platforms are not Singapore stocks or Asian stocks. It's actually 65% attributable to the US stocks. And of the remaining 35%, the bulk of them are actually Hong Kong stocks. That is actually done via the Northeast Connect or the Southeast Connect, meaning that mainland Chinese using this platform to buy Hong Kong stocks like a Tencent. So it's interesting because this momentum is still continuing. And if you look at the two brokers, the way they make money is through share margin financing. That amounts to about 82% of the total revenue as opposed to trading commission. Because in the first place, for them to launch and get market share from the incumbents, the likes of your Maybank Kim Eng, your UOB Kay Hian, you actually offer almost close to zero commission. So this is the likes very similar to what Robinhood actually uses in Europe itself.
Now, Gabriel, thank you very much for coming on the show, and thanks for your insights.
Pleasure, Brian.
Now, we've been speaking to Gabriel Yap, Executive Chairman of GCP Global, on the ASEAN Midday Market Watch. I'm Brian Fernandez. Check out www.bistech.asia for business and technology conversations.